And it is Monday, October 7th, 2024, and it's time to begin tonight's episode of Navigating the Markets with me, Markets and Mayhem. First, the risk disclosure: all trades and investments involve the risk of financial loss. The value of positions can go down as well as up, and past performance does not guarantee or predict future results. With that being said, let's look at the heat map from today, because today NVIDIA really was the market. It was rather incredible. And if we drill down into the statistics, even though the overall market didn't close too red, there were only 24.7% advancers versus 71.7% decliners. And we're still in a market that's just a little bit stretched, with 67% of stocks making new highs, 60.9% of stocks above their 50-day average, and 66% above their 200-day. So we could still see some retrenchment here as we get into earnings season. Really, peak earnings season isn't here quite yet, but in just about a week and a half, 2 weeks, we're going to get into the nitty gritty of it. And as we get into it, as I was talking about last week, we have a lot of those buybacks on pause, which takes away some of those important flows. And this isn't a very liquid market environment either. The order book depth varies from 35,000 to 40,000 on the S&P futures contract for December. That's the most active contract. And that means it doesn't take a lot of flow to move the market around. Like we saw the market kind of flailing around aimlessly while Kashkari was speaking. And the headlines, the things he was saying, didn't necessarily warrant the reaction, but because there's such a thin book, you get these bigger reactions, right? And that makes it more likely you can get stopped out, which means for me, I've got to use wider stops, smaller size, and more discretion about what trades I'm going to put on. Now, if we zoom this out a little bit further and we look at this heat map over the course of a month, we can see the same thing. It's this same sort of theme of rotation out of a lot of these stocks, a little bit of a risk-off type of environment that we're seeing in the broader market, especially out of the Mag 7. In fact, we'll get to a later chart from Goldman that shows there's been a flow out of hedge funds, really getting out of a lot of these Mag 7 stocks and getting into other parts of the market. But before we go there, let's just micro zoom in to the S&P futures and look at some of these pivot levels. I think it's pretty important right now that we're below 57.6750. That is going to be my real key pivot going into tomorrow. I think if we can get above it, we could probably get back up to like 58.0525 pretty quickly. But as long as we're lingering below it, we've got room lower. We've tested that 57.3275 level almost on the dot earlier. You could see some of those candles, just kind of touching right close to that pivot. And it looks to me like if we're going to trace down below that level, we've got room to 14.75 and then 56.92.25 based on these pivots. And these are dynamically generated based on analysis of volume profile. So we're looking for places where there could be an opportunity for the market to make an important decision, and then we're breaking those down programmatically throughout the trading day. The same pivots also exist for the NASDAQ here, and I'm going to look at 20,025.50 as a key pivot level. I think if we get back above it, we could easily trace back up almost 100 points to 20,116.25. Otherwise, I believe the path of least resistance would be lower, and we could see some support around 19,976.75 and 19,930.50. So those are two, kind of key areas to watch in the S&P and the NASDAQ, those pivots. I do think that we're in a market where that kind of volume profile driven price discovery is more important, as is the options profile driven price discovery. Basically, where people have wanted to transact and where they're showing interest in transacting matters a lot more even in an illiquid market. And what event volatility catalysts we have, and we've got CPI and other things this week that could change some of those hedging flows, also can play a big deal in how prices are discovered. So let's get into some other technical charts, zooming out a little bit here. NVIDIA finally breaking above this descending trend line in a more meaningful way today, which I think is pretty interesting. We do have some resistance overhead. We talked about some of that flow earlier today. Just after 10 a.m., I started looking at a lot of positioning around that 130 strike. Then we started to see the flow coming into that strike, and then we finally filled a resting offer there that had over 3 million shares, about 3.2 million was filled. just sitting above, wanting to get that fill. I do think that if we can break above that 130 on a closing basis, we've got some chunky room higher, possibly even retesting some of those highs that we'd seen in NVIDIA over the summer. But right now, it's still guilty until proven innocent, because that's a large low volume area up there, and we rejected it. Even though today NVIDIA closed green, we did reject that key resistance around 130. So I need to see a close above there to tell me we've still got some juice higher for that stock. The NASDAQ does not look quite as bullish. It continues to reject below this key level of 484.56 on QQQ. I don't think that things really start to look bullish again unless we can build above that, and really, ideally, build above 491.24. For now, we continue to see supply overhead. And note, like with NVIDIA, this is also another area of low volume. So it is a real decision area for the market to let us know what it wants to do. We could see in the past, this area was pretty gappy too. People really didn't want to transact in this level. And the last time we sort of head faked above it, we got rejected pretty nicely off of it. So I would be looking at both NVIDIA and QQQ with just a little bit of side eye here. They do need to show us that they have room higher. Otherwise, support starts to come in at their respective 20-day moving averages. Now, one I like here, this is one we talked about earlier. This is XLE, and it has put in this inverted head and shoulders pattern, and it continues to run higher. We've got Hurricane Milton, who's now a Category 5 that is already starting to disrupt some oil and gas production in the Gulf, some being preemptively shut down so as not to be otherwise destroyed or create spills or other kinds of safety issues. And that also has an effect. So that's the one hand. The other side of that, of course, is if the storm is bad and it makes landfall, it can slow the regional economy. Because if you think about it, if Florida gets hit really hard, if the Southeast gets hit really hard, that does knock down GDP a bit, because you're going to reduce consumption overall until that rebuilding phase. So it is a mixed picture. In the near term, production being disrupted is bullish for oil. But if we do actually take a sustained hit, that could actually reduce energy consumption. And then we could see it start to come back as you have that rebuild. I would also just say, to everyone out there that's in any of these impacted areas, I wish you, your family, your friends, safety throughout all of this, because it has been just crazy, the stuff we've seen from hurricanes this year. Another one I like is Halliburton. This is what I'm looking for. Oh, and by the way, let's just go quickly back to XLE. Let me just talk about the price target I have on this one is 96.19. That's just where I think we could retrace back to based on prior areas of volume profile and where some of the options interest is. Moving forward to Halliburton, this is sort of a hybrid. It's mostly energy services, but it does some defense contracting. Both of those areas starting to look a bit more, I would say, intriguing to market participants, and we'll look at that in the flow in just a little bit. But I would say that right now we're at a pretty key level. This 32 level overhead is likely to be somewhat decisive for the stock. We could see that's a pretty big low volume node, but I believe that we can start to climb higher. And my near-term outlook for Halliburton would be if we do get a pop in oil from here, moving further, and that's caused by either weather, geopolitical tension, or some combination of the two, I do believe Halliburton could move quite a bit higher from here, and I'm looking at 34.81. So that's almost another 10% from where it is right now that I'd be looking for upside in this stock. Now, the next one I like is JP Morgan, and for these, I'd be guarding my risk with the 20-day moving average, keeping it simple on a momentum front. And so JP Morgan, I think, is another one that could move maybe a little less, about 5%, but from current levels of $210.93 on a closing basis to $223.52. I just think that it could re-explore this lower volume area and get back up there pretty quickly. This is one of the more fortress balance sheet banks, so I don't have any near-term concerns about it. And I think as the yield curve starts to normalize, this should be constructive for a lot of the money center banks that are lending off the short, sort of borrowing off the short end and lending out off the long end, essentially, and trying to capture some of that spread plus whatever markup they have. Another one I like, and this is a trade that I've talked about last week, was going long the dollar versus the yen. And boy, it's been a good one so far. We've really seen it rally above the point of control. And I started getting interested in it when I saw a positioning chart, I think it was from Deutsche Bank, showing that yen positioning is about as long as it's been in a long time. It flipped from being massively short to massively long. And yet there's a lot of mispricing of how far the Fed is going to go and how far the Bank of Japan is going to go. And so I feel like the yen is actually a really good short, the dollar a good long against it, particularly as we see rates firming up in the US. So I'm looking for 157.91 on the yen for upside. on the USD JPY, I should say. So shorting the yen, longing the dollar, that pair going to 157.91. And that would be where I'd take off that whole position. But I'd guard risk with the 20-day on this as well. And then there's gold. Gold is one that we've been long for a long while. It still continues to work here. It's this constructive stair-step pattern higher. This is exactly what you want to see in precious metals, this sort of progression over time, this sort of steady stair-stepping into higher territory, because this tells you it's not getting ahead of itself too much. We have read some headlines, however, that are a little concerning. The amount of flows coming in from China, the amount of gold flying off the shelves at Costco. We're definitely getting to a point where it'd be healthy for it to consolidate or correct a little bit, but I am still looking for $3,000 gold in the first half of 2025. Next up, we've got silver. Silver, I need to see it crack 32.43 or 44, ideally. Really, I'd like to see it crack 32.50 on a closing basis. And then I think we could start to re-challenge some of those multi-year highs. Next year, I am looking for silver to try to ping that 2011 high of about $48 an ounce on improving industrial demand. That's the key part of my thesis. I think investing demand will stay healthy, but I need to see industrial demand pick up, because that's the other leg of silver for it to really go into a bull market. We've seen some near-term encouraging signs, but I'd really like to see more fiscal stimulus in China, as they're one of the world's larger users of silver, and it would probably be for things like their renewable projects, communications, military uses, and otherwise that silver could catch a bigger bid. It's also starting to be used more in some battery technology. Now let's go back to what I said earlier about the Mag 7. We do see hedge funds reducing their positioning to levels we haven't seen since May of 2023 per Goldman Sachs. That's where this chart comes from. And they're one of the largest prime brokers for hedge funds, so the flows that they track are pretty important. This tells us they've lightened up positions, but it also tells us they're really not looking for getting aggressively long in tech anymore. And this is the so-called smart money. They are rotating. They are broadening out their exposure to other sectors and industries and other geographies. And I think that for us as investors, it behooves us to be aware of that flow, because it's likely that this is actually a smart rotation. That is to say, I believe we can still see the equal weight S&P outperform the market cap weight. I believe there's some rotation out of growth into value, and some rotation out of some of the high flyer FANG stocks or Mag 7 stocks into high dividend stocks. They tend to do well in an environment of interest rate cuts as people look for income elsewhere. Now, another area that is pretty hated that could offer some opportunities is, of course, emerging markets. Looking at emerging markets, the ratio versus U.S. equities is the lowest since 1969, based on this Bank of America chart. And I think that there are certain areas of emerging markets that could be worth considering and other areas that may be worth avoiding. But right now, I do like Malaysia. I like the Philippines. I think there are some pretty constructive trends at work in those two markets. I'm not quite as convinced about China yet, but I do think if the fiscal stimulus in China goes much farther, if the government gets more aggressive and we start to see that really pick up the economy and directly take some of the slack out of their $62 trillion real estate market, that could bring Chinese stock valuations higher, as previous stimulus measures have, right? So we could be looking at some decent upside, but in my opinion, for that not to be short-term pop and drop, and for it to have more than, say, 15-20% upside from here, we really need to see more aggressive stimulus. Basically, a fiscal bazooka aimed at the real estate sector and probably infrastructure and otherwise to really get things going again in the laggard country, which has become one of the better performers this year. But if you zoom out to a 10-year chart, China is no friend of foreign capital. Another area that's hated is oil. Even though oil is trading with, it's been on a tear from its lows in the 60s, it is, for the first time in the product's history, net short. That's pretty incredible if you think about what that means and how far stretched that positioning is for people to want to be shorting oil into an environment where there's rising geopolitical risk, where there's central banks cutting rates around the world, which could presumably increase demand, and where there's storms and other situations that could disrupt oil production and availability. So if you think about all that, it kind of tilts the scales a little bit, makes me still want to look at energy somewhat bullishly, even though we've had that move off the lows and that inverted head and shoulders bottom in XLE, like I'm looking with XLE and HAL, I still think there's some upside from here. And I'm not alone in that thought. We can see that Morgan Stanley is showing a decent amount of inflows into energy recently. Right? So it's like very recently that we're starting to see some of these guys lighten up on their shorts. And what I mean is, on a net basis, hedge funds are still extraordinarily short energy. This is a chart that the further up it goes, the more short they are. You can see that little tiny move lower. That's some short covering in energy. And that's where some of these flows are coming from, which tells you there's a powder keg of motivated buyers if price continues to run higher in the stocks in oil. It's something to keep an eye on, and so is Milton. As we can see, as we get through to Thursday of this week, we're going to have a much better idea as to what kind of production impacts it may have, if there's any equipment damage, and how long those production impacts may last if they happen at all. So again, hoping everyone that's in the path, anyone who has friends and family out there, that they stay safe throughout this. This is a category 5. This is no joke. And if it lands on, anywhere near Florida with that kind of wind force, I think earlier they were quoting 170, 175 mile-an-hour winds, it could get pretty nasty. But as it travels through the Gulf, it can still create these waves and these winds that can knock out production facilities. So it's very likely a lot of that production is already shutting down ahead of the storm moving through. Now, another thing that's really noteworthy is we're seeing the largest, on a historical basis, September 2024 was the 4th biggest month for central bank cuts around the world in the 20th century, in the 21st century, right? That's pretty incredible if you think about it. That's an enormous amount of cutting. It's only dwarfed by the great financial crisis and COVID. So if you think about what kind of liquidity flood that brings into the market, that's extraordinarily bullish for things like gold and silver. It's also bullish for oil. In fact, oil really loves excess liquidity. And if you look at this chart from Bloomberg and Macrobond, you can see it suggests we could continue to see oil move higher even from here. I think the other part of this that's quite interesting is it just suggests there's a lot of money kind of looking around for a home in a world that is increasingly full of angst. And if you look at the oil market itself with the washed out positioning, some of that money in the market may find its way back there. So that's everything I've got for this week's episode of Navigating the Markets. I hope it was helpful to you and your trading process out there. If you have any questions, let me know. And I'll be posting this later for anyone that wasn't able to catch the whole thing and wants to rewatch it. So I'll catch you next Monday, 5 p.m. Eastern, same time, same place. See you then. Good luck this week.